Hi, I'm Andy. This is Investing Book Highlights. You can help build this channel by clicking like and subscribe. And now, on with the show. I started reading investing books 2 years ago. I took it to heart when I learned that the best investors in the world read, and they read a lot, and they read a variety of different topics. Investing Book Highlights is here to help investors navigate the large selection of investing books available. So when I read a book with my yellow highlighter, I highlight important sentences or passages. Some books I'll highlight a lot, some books I'll highlight a few, and some books I don't make any highlights at all. Highlighting when you read is something I definitely encourage. One Up on Wall Street was the 22nd investing book I read. Originally published in 1989, it was written by Peter Lynch with John Rothschild. I bought the 2000 edition on October 7, 2019. It has 304 pages and I made highlights on 12 pages. The fact that I made only 12 highlights shouldn't dissuade you from this book. While I'm not here to do a book review, in preparation for this video, I did find myself reading large sections of the book and enjoying them. I think my lack of highlighting came down to having already read some of this book's ideas in other books. But since One Up on Wall Street was written in '89, maybe those other books took some ideas out of this one. The first highlight comes from page 13. If you can follow only one bit of data, follow the earnings, assuming the company in question has earnings. We see businesses in the real world that close down. For the most part, they probably stop making money. Sometimes we see a closure coming. We notice less customers or the lowering of stock levels. And when they close, we're thankful we weren't invested in them. And yet, investors in the stock market buy into businesses whose earnings are dropping or have dropped off completely. Peter points out the importance of not only following a company's earnings to gauge how the company is doing, but to invest in companies that do have earnings. The second highlight is from page 50. Logic is the subject that's helped me the most in picking stocks. I like the simplicity of this. Logic denotes a framework. It isn't investing in a company because a friend recommends it or because you like shopping there. These can be items in the framework, but not the whole framework itself. A logical, well thought out investing framework should make you a more successful investor. The final highlight comes from page 261. I've never been able to predict which stocks will go up tenfold or which will go up fivefold. I try to stick with them as long as the story is intact. Peter Lynch coined the term 10-bagger, and since then, investors have been on the lookout for these elusive companies whose stock price goes up 10 times. But here he admits that he couldn't predict which investments of his were going to be 10-baggers or even 5-baggers. The fact that he held on to good companies for an extended period of time was what gave him the 10-baggers. Thank you, Peter Lynch and John Rothschild, for writing One Up on Wall Street. In each video, I tally up the cost of the books I've read. As this was book 22, the total cost is $600.53, and that's in Australian dollars. And One Up on Wall Street is suitable for intermediate investing book readers. To help build this channel, please click like and subscribe. And leave a comment or question below, and I'll be sure to follow up. And I hope your day is full of highlights.